एवरीवन, कैसे हैं आप सब। टुडे वी आर डूइंग फाइनेंशियल डिसीजंस। ये 3 टाइप्स का होता है। फाइनेंसिंग डिसीजन, फाइनेंशियल प्लानिंग और कैपिटल स्ट्रक्चर होता है। इन्वेस्टमेंट डिसीजन में फिक्स कैपिटल बजटिंग डिसीजन और वर्किंग कैपिटल होता है। और डिविडेंड डिसीजन के अंदर डिस्ट्रीब्यूशन ऑफ डिविडेंड और रिटेन्ड अर्निंग होता है। तो डिविडेंड डिसीजन, इन्वेस्टमेंट डिसीजन के ऑलरेडी वीडियोस जो हैं हमारे बने हुए हैं, तो आप उसको प्लीज़ वॉच करिए। आज मैं आपको समझा रही हूँ फाइनेंसिंग डिसीजन। फाइनेंसिंग डिसीजन के अंदर 2 स्टेजेस होती हैं। फर्स्ट स्टेज होता है फाइनेंशियल प्लानिंग और सेकंड स्टेज होता है कैपिटल स्ट्रक्चर। सो चिल्ड्रन, वी विल डिस्कस द कैपिटल स्ट्रक्चर। पहले पढ़ते हैं सोर्स ऑफ फाइनेंस हमारा क्या होता है। इक्विटी, इक्विटी शेयर कैपिटल, प्रेफरेंस शेयर कैपिटल और रिटेन्ड अर्निंग्स हमारे सोर्स ऑफ फाइनेंस में इक्विटी साइड में होते हैं और डेट साइड में होते हैं हमारे डिबेंचर और लोन। और डेट और इक्विटी का जो रेशो होता है वो हमारा पूरा वर्क करता है आपके फाइनेंशियल प्लानिंग के अंदर, आपके कैपिटल स्ट्रक्चर के अंदर पूरा वर्क करता है। तो फर्स्ट स्टेज को पहले हम पढ़ लेते हैं। फर्स्ट स्टेज के अंदर आता है फाइनेंशियल प्लानिंग। तो फाइनेंशियल प्लानिंग में हम क्या करते हैं? डिटर्मिनेशन ऑफ द फाइनेंशियल ऑब्जेक्टिव, formulation of financial policies and rules, forecasting the need of finance, developing alternative course of finance, selection of best alternative, implementing financial plans and policies। तो ये इम्पोर्टेंस क्या है फाइनेंशियल प्लानिंग का? टू एंश्योर द अवेलेबिलिटी ऑफ एडिक्वेट फंड्स एट ए राइट टाइम, हमें सही समय पर फंड्स अवेलेबल हो जाएं। To see what the firm does not raise fund unnecessarily कोई भी जानबूझ के बेकार में कोई फंड रेज नहीं होना चाहिए। It provides policies and procedure for the sound administration of finance function. It results in preparation of the plans for future. Thus new project can be undertaken smoothly. It attempts to achieve a balance between the inflow and outflow of funds. Adequate liquidity is ensured throughout the year. It serves as the basis of financial control. The management attempt to ensure utilization of funds in tune with the financial plans. तो सेकंड स्टेज होती है हमारी कैपिटल स्ट्रक्चर। The main source of funds are owners fund, that is equity shareholders fund, and the borrowed fund, that is debts. Borrowed funds have to be repaid at a fixed time, and thus some amount of the financial risk is involved, that is risk of default on payment. Is there any debt financing? Moreover, interest on borrowed funds has to be paid regardless of whether or not a firm has made a profit. On the other hand, shareholders fund involve no commitment regarding payment of returns or repayment of capital. A firm mixes both debt and equity in making financing decision. Now children, capital structure. Capital structure refers to the optimal mix between owner's fund and borrowed fund. It will be said to be optimal when the proportion of debt and equity is such that it results in an increase in the value of equity share. The proportion of debt in the overall capital of a firm is called financial leverage or capital gearing. When the proportion of debt in total capital is high, then the firm will be called highly levered firm. But when the proportion of debt in the total capital is less, then the firm will be called lower levered firm. So financial leverage is equal to debt upon equity. This is the children formula. So factors affecting capital structure of financing decision. First is trading on equity. It refers to the increase in profit earned by the equity shareholders due to the presence of fixed financial charges like interest. Trading on equity happens when the rate of earning of an organization is higher than the cost of which funds have been borrowed and as a result, equity shareholders get a higher rate of dividend per share. The use of more debt along with the equity increases EPS. EPS is earning per share as the debt carries fixed amount of interest which is tax deductible. Now example is there are three companies, company X, company Y and company Z. Here equity share capital of rupees 10 each. This is the amount, children, and 12% preference shares and debentures are like this. So total capital will be added like this, and earning before interest and taxes EBIT is this 25% less interest on debt will be minus, then profit after tax is this, and tax 40% like this. Profit available for equity and preference shareholder will be this. Then less preference dividend, then profit for equity shareholders XYZ, number of equity share, and earning per share EPS will be like this. X 1.50, Y company 2.40 and company Z is 4.20. Thus EPS of X, Y and Z is higher than the company X because of the application of the trading on equity. Second point is cash flow position. In case a company has a strong cash flow position, then it may raise finance by issuing debts as they are to be paid back after some time and interest has to be paid on debt. Third point is interest coverage ratio. It refers to the number of times earning before interest and taxes of a company covers the interest obligation. High interest coverage ratio indicate that company can have more borrowed funds. Formula for calculating ICR is equal to EBIT upon interest. Fourth point is return on investment. If return on investment is higher than the rate of interest on debt, then it will be beneficial for a firm to raise finance through borrowed fund. Fifth point is flotation cost. The costs involved in issuing securities such as broker's commission, underwriter's fees, cost of prospectus is called flotation cost. While selecting the source of finance, flotation costs should be taken into account. Sixth point is control. When existing shareholders are ready to dilute their control over the firm, then new equity shares can be issued for raising finance, but in reverse situation, debt should be used. Seventh point is tax rate. Interest on debt is allowed as a deduction. Thus, in case of high tax rate, debt is preferred over equity, but in case of low tax rate, more preference is given to the equity. Eighth point is cost. The cost of raising funds from different sources are different. The cheapest source should be selected. Ninth point is risk. The risk associated with different source of is different. More risk associated with borrowed fund as compared to owner's fund. Next is as interest is paid on it it is to be repaid also after a fixed period of time or an expiry of its tenure. Tenth and last point is period of finance. For permanent capital requirement, equity shares must be issued as they are not to be paid back. And for the long and medium term requirement, preference shares or debentures can be issued. Now few questions are: state the formula for calculating financial leverage, 1 mark question, that is debt upon equity. What is the impact of business risk on capital structure, 1 mark question. Increase in risk will decrease use of debt. Now third question: under what situation will the increase in debt decrease the EPS? Answer is when rate of return is less than the rate of interest. Second is decrease in earning. Next question is cost of debt is lower than the cost of equity share capital. Give reasons why even then a company cannot work only with debt. Answer is because equity share capital is a permanent source of capital and provide risk capital. What is favorable financial leverage? 1 marker question. Answer is when capital structure has more debt than equity. Thank you very much.